Would you rather own the best building in a bad market or an average building in a booming market? Well, today we're going to be breaking down which one is better. Some investors, they invest in cap rates, they chase headlines, but the smartest ones, the smartest real estate investors, they chase migration, job growth, affordability, or in other words, location, location, location. The problem is most investors don't actually know how to evaluate a location though. And today, John and I, we're going to be breaking down which factors you should be looking at when you are identifying a market to invest in. John, it's great to be here with you.
Yeah, Mark, no doubt. Both of us have spent our whole career in real estate, right? And that adage, location, 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 it's there for a reason. Now, what's interesting, and you mentioned the headlines, even within a location, it's like really the neighborhood, the submarket, right? And so it's an area that we here at Faris Capital Partners spend a lot of time on. So we don't just say, oh, Atlanta's a good market. No, it's the submarkets that we're looking at. So it is a very time intensive process, candidly, to dive into this data and to ensure you're making the best possible decision. But, at the end of the day, the best asset, it's kind of like you don't want to be the nicest home in a bad neighborhood, right? You want to be the affordable option in one of the best neighborhoods. And that's always been our strategy here at Faris Capital Partners. So, yeah, really looking forward to diving into today's topic.
Yeah, no, and it's so widely used, right? Location, location, location. Everybody's heard that before, but the reality is you might be living in a location that you think, oh, this neighborhood or that neighborhood, but the city itself may not be a great spot to invest overall. And so, John, where I really learned this is so as you know, we're both
Yeah.
real estate brokers. And so I cut my teeth in an area just north of Toronto. And I knew all the areas, and eventually what happened was when pricing went up and interest rates doubled, it was harder and harder to find cash flowing properties. And so what was interesting is that I just thought that you couldn't find cash flowing properties, and then I started looking outside the area, and I started looking down south, and I started realizing that after doing my research that there's always an emerging market somewhere.
Hmm.
And so today is going to be a really strong episode talking about how do we identify what a strong location actually looks like and what are the key factors to be able to assess if an area is location, location, location. Because as I mentioned in the heading there, as that at the starting point, is that you want to be able to get a really good deal in a phenomenal up and coming market. If you get the best deal in a losing market, we'll just say take Detroit for example. If you bought a phenomenal deal and all of a sudden all the automotive left, all of a sudden that amazing deal is no longer an amazing deal. And that is such a good example. We saw population growth decline massively in Detroit when automotive left. And so that's where, just to kind of give it perspective, what we're talking about here is that if you buy in an area and it's on decline, even if you thought you bought it at the right market, you're going to lose. You want to buy into an area that is already starting to improve. So this isn't guessing, you're already starting to see the market incline. And so you want to be able to get ahead of the ball before you see that massive growth. And so that's what we're going to be talking about today.
Yeah, no doubt. And, for us, Mark, right? I mean, it was actually the first thing we thought about before we thought about the type of assets we wanted to pursue, right? When we were kind of developing our buy box. And for a listener here, buy box is just sort of the term of art within the industry that just describes the type of assets we're pursuing, right? So the vintage, size, is this value add opportunistic, right? But that location was the first question we answered for. And of course, we started with Florida, just because of, the high population growth. Our company formed post pandemic where a lot of these migration patterns shifted dramatically. Now, Florida was already a market that was experiencing high population growth, but it just, exploded, right? And so for those reasons, we were seeing companies relocate there. But then we started kind of going, okay, what other markets? And we've been thoughtful and we've really nailed down like 3 key markets. Now, we're always looking for that fourth or fifth, right? We're not going to just limit ourselves, but it is a long process of evaluation. When we consider a new market, we go in and study every sub-market. We run comparisons, and then we look at it compared to the other markets we're already serving to see how they correlate and if there's opportunity before we make that decision. So, it's interesting, Mark. We have kind of a front row seat in a lot of ways to what is happening in the marketplace. And there are a lot of operators that are challenged today. And that's because as the market rose so rapidly, there was this period of time where you kind of couldn't lose. In other words, if you bought a deal in a couple of years, it was probably going to be worth more because we were seeing property values increase so dramatically so quickly due to market factors outside of the operator's control. But then, as you pointed out, interest rates rose, and all of a sudden, you see a lot of operators who have, I love that Warren Buffett quote. He says, when the tide goes out, you find out who's not wearing a bathing
John, that's
suit.
exactly what I was thinking of when you were saying that. All of a sudden, I see the tides going down, and it's like,
Yeah.
oh, just had a visual there for a second.
That's right. That's right.
Yeah.
So, by having that front row seat, we can learn and it is what it is. It's not that we're happy or celebrating this. We never want to see, friends of ours in the industry or people we don't even know needlessly suffering. But, there's an ownership component, right? You and I are both big believers in extreme ownership. And one of our fundamentals is like, we own our wins, we own our losses, no excuses, right? And so with that, we can kind of see what they did. And for example, there's an operator that I would say we're fairly close to. And when I went on their website, I was sort of shocked. They own assets all across the United States. I mean, Omaha, Utah, Florida. And, in my mind, without, getting into their psychology, I just said to myself, I'm like, how could you possibly know all those markets in an in-depth way where you're knowing you're making that right decision? So, Gary Keller, who started Keller Williams Realty, was sort of a mentor, my former business partner. And through extension, I got that mentorship. His big thing, and it's in the book, The One Thing, right? A lot of people have read that book, but go small to go big. And what that means is have a niche, focus on a certain area. And until you master that, then you go out to another area and expand, right? So Mark Spain Real Estate Faris team, we only do residential resale real estate. We're not doing foreclosures. We're not doing, builder business. We're keeping it really tight and doing it really well. And we're applying that same principle here. So those locations are so critical because a good property in a bad area is a bad investment, just at the end, the bottom line, right? And this is a factor of supply and demand. It's no different than any other business, right? So we want to go to areas where there's more demand than supply effectively. And there might be, say, new supply coming online, but we're in an asset class, like we like that B asset class. So we look for areas where there's a lack of quality supply in that B class. And we know we can come in and get it to feel like an A class, but at a B class rent. And that's why we're winning and why we're ahead on our pro forma on all of our deals to date. So that location is so critical. So yeah, definitely excited to dive in today.
All right, John. So we have 6 principles we use to evaluate our markets. Okay. So we're going to break down the 6 and we're going to get through this. And by the end of the talk here, you're going to have a really good understanding of how to evaluate markets. Now, just before we jump into the 6 principles, if you want to learn more about our 10-step full out investing process and see a sample deal, go to fulloutinvesting.com. That's going to give you a really good understanding of not only what we're taking on regards to the assets that we're purchasing, that you could potentially come and partner with us, but even if you're your own operator and you're doing it on your own, you're going to learn a lot by going in and seeing our approach and, take as much as you want from that and apply it to your own business, real estate business there. And hope it's extremely valuable. Go to fulloutinvesting.com. All right, John. So we got our 6 principles here. We're going to be diving in. So number 1 is population growth. Population growth. So where are people moving to? We like that because this means that our customer base is growing. When you have your customer base is growing, that's like 101 in business. You want to be getting into a market where there's a growing customer base. And our customers are renters, anybody that's looking to rent. We call them residents. This is something that we want to have more coming into an area. We don't really want to have stagnant, right? We don't want to have the same. We want to be able to, because if you have a lot of new inventory coming in and build, all of a sudden, what you have there is going to get watered down. And so it's going to get harder and harder for you. If you're buying into a market where there's more and more people in demand coming, that's going to drive your overall rental rates. And it's like having the current at your back. So why not buy into a market where the current's at your back instead of fighting, going against the current because, maybe that's where you live. And so that's one of the benefits of what we do is that as a group, we have team members all across the US and we have a really good understanding and we're not, say, dependent on one area because this is where we live. We're going and we assess the best cities, and we say this is strategically the best area. And then what we'll do is we'll build relationships with brokers in that area, and we'll do a deep dive and we'll fully understand it. And when we find an asset we like, we fly in and fly out. And so we can be able to get the best deals in the best areas as well. It stacks the odds in our favor.
That's right.
And there's so many ways you can get at this information. So, in the United States, there's a census done every few years. So there's great websites. For example, dataus.io is a website you can go to and search for specific submarkets and areas, and it talks through those population trends, but it also gets into things like average income and some of those other key factors, which we'll get to. But there's some unconventional ones that a lot don't think about it. We've mentioned some of these on previous podcasts, but U-Haul publishes a report on an annual basis showing one-way truck rentals. So, right, somebody's renting a truck, say in New Jersey, to go to Charleston, South Carolina. So they track that. So that's another data source we can use to see, okay, where are these migration trends? Where are people moving to? Apartments.com, for example, is a website that is sort of like the Zillow for residents looking for an apartment building. I don't know what the equivalent would be in Canada, but that resource, everybody goes to look for a new home in the US at Zillow. So apartments.com. And so what they can do is they can see, one-way apartment inquiries. So in other words, somebody's in a market, but inquiring about an apartment in another market. So that's a report we look at. They publish that quarterly. But also the United States Postal Service, right? Changes of address get processed. So they can kind of publish data on where are addresses changing to and what does that mean towards population trends. So we pull all that stuff together, and that's how we make these decisions. So for example, our most recent deal in Georgetown that we're under contract on, they're projecting 6% population growth in just a 3-mile radius around our building, right? So that shows that population will continue to be there, that demand will continue to increase with 30+% of that market renting. So population is the first checkbox. If that's not there, it's a major question mark. Now, there are occasionally, say, at a submarket that's sort of fully developed, maybe an in-town community where there's just simply no more land to build and it's well developed. And so, there are circumstances where you would consider that. But what we do in that situation is we look at a little bit further out of a radius to see, is the population trend still coming in? Maybe just not to that submarket that could support that rising demand. But at the end of the day, if we don't see net positive population growth, it's usually a market that we're not interested in investing in.
You got it. Principle number 2, job growth and diversity in jobs as well. This is a really good one. You don't think about it sometimes. You go into a city and you're like, okay, I'm going to buy there. Everything's looking good. But when you dig in deeper, you realize that there's a huge population of, we'll just say, military. Maybe it's, there's a massive base there. And if there's war and they're all called in, you're going to lose a good percentage of your resident base. And so that's just an example. Another example is Detroit. Detroit, yes. When automotive left, all of a sudden those the real estate pricing dropped dramatically because there's a lot of people that moved out.
Yeah.
And so you want to make sure that you're buying in an area that's very diverse in employment, number one. So there's a really good mix of different industries that are in that city. So if one industry gets hurt, then you can fill it in with the rest of the industry. So you're not so dependent on one because that's exposure there. And the other thing is you want to have employers and employment moving into an area, because if you have employment moving in, then they'll bring people. That'll help with that first principle of population growth as well. And when people are moving to an area, they want to be able to have a place to work as well. So that's number 2 is job growth and economic diversity in the types of jobs as well.
Yeah, just to illustrate that, right? Like an area that has great job opportunities in, say, healthcare, education, logistic, tech, manufacturing. So you're getting diverse employment from different sectors, but also different income levels, right? So it's candidly why we like coastal regions, right? The United States has just a very interesting geography, and we have more natural ports just in the United States and the rest of the world has combined. In other words, most other areas they have to build ports. Our just geography allows for it. So the port of Savannah, the port of Charleston, all these things, you know, stuff's coming in from overseas. It's got to get manufactured somewhere. So it's natural that you want to build your manufacturing concern closest to those ports, right? And then Atlanta, that Savannah port, they're actually building a terminal where they're actually bringing more of that straight in over rail. So we're seeing an explosion in new manufacturing and logistics in the Atlanta area because of that. So, defense, right? So you mentioned military bases. What often happens, say Charleston, for example, it is a military area. It's not dominated by the military. There's all this other diverse employment. But because that's there, you bring in a lot of those defense contractors. And when the United States spends $1 trillion a year on defense, it's not as if that money's going to run out anytime soon. So those are really great, stable jobs. So Boeing and companies like that that have locations in Charleston, as an example. But Volvo, right, in Charleston, they have a major manufacturing plant there. BMW just about an hour away. So, we look at the Bureau of Labor Statistics, business journals, to look to see, to your point, are there new companies moving in? How many jobs will that be supplying? And, could be the newspaper, right? So we do a lot of that research, and then we take it a step further. We actually call the local planning and economic development board with the local government just to find out what's in the works, what's happening, what jobs are coming. So once again, this is a lot of work. I mean, it's just about as much work and maybe more work than that we put into kind of defending the submarket we wanted to invest in as we do underwriting the actual deal itself.
Yeah, for sure. And so there we look around the asset as well, and how far is that employment from the asset that we're purchasing as
That's
well?
right.
And is it drivable or not? Like, we just put ourselves in the resident's shoes. Does this make sense for me to live here and go to work at these places? And so if the apartment is way out in the middle of nowhere, we understand that somebody's going to need to do a big commute, and some people don't want to do that.
That's right.
So that's principle. Number two. Number three is supply construction pipeline. This is a big one because it's kind of can come under the radar, and all of a sudden it can bite you if you're not careful. Right. So, so we track number of permits issued. So what's coming down the pipe, and so these apartment communities, they generally take a couple of years to build, and then about 8 months to lease up. And so the good news is that we can look down the road and see what are the new deliveries that are coming, and how we track that is it's actually through CoStar. We spend tens of thousands of dollars every year, Faris Capital, to be a part of this to make sure that we have the right data to make the right decisions. So we can track the number of new permits that are actually issued. And you can go to the city as well to get this data. But the point there is we want to be able to look down the road and say, okay, where are these new developments coming in? And is it going to be coming in right across the street? Because you could have a beautiful deal, but then if they need to lease up 300 units across the street and they say bring down, it's brand new construction, it's beautiful construction, and maybe you're a B-class asset, the reality is they're probably going to be doing some concessions at the beginning to lease it up. And all of a sudden, their lease amounts that they're charging could be actually less than what you're charging. And that can really affect your pro forma, your overall projected rents. And now you're going back and realizing I can't get the rent that I thought, and it just snuck up from behind you. So doing your research up front will make sure that you don't have any, I didn't see that coming.
That's right. And the thing with concessions that's interesting, Mark, is that a lot of you might hear that and you assume, oh, they just discount the rent. Well, generally what they actually do is they keep the headline rent strong, but they give a month or two for free, right? So on the pro forma, on their rent roll, yeah, we're getting $1,800 a month, but the impact of that 2 free months is felt. It's really there. And so, once again, just because you see it being advertised at a certain place, we just operate under the assumption that a brand new delivery is going to give concessions because they have to get to a certain lease ups, typically 60, 70% before they can refinance out of their construction debt. Construction debt is very heavy on interest. So they have very motivated to get out of that debt quickly. So it's just a foregone conclusion in my mind. Even if they're not, we just assume that they will. Now, this is another thing, right? At the end of the day, CoStar, we can call the government, we can do all these things to try to get to the bottom of it. But when you're on site, we take it a step further and we just drive the area. And if we say a vacant piece of land and maybe there's a for sale sign on it or who owns the property, we do some research. Is this zone residential or is this zone commercial? what is going to be built here. And we've had a number of examples. We're on the asset, we look behind and there's a big piece of wood, wooded area. You're like, what is this? So for example, a deal we're looking at in Noonan, Georgia, one of our newer deals will be launching soon. We saw that, come to find out it's a cemetery, so it can't be developed. So that's great news. But we didn't just sit there and just go, well, I don't see any permits. We did the research to confirm that this is not something we need to be worried about. So you have to go even beyond the data. You have to actually drive the area and just get a sense of what's happening in the area. And if there's vacant land, going and pulling out the plat maps and trying to figure out who owns it, what the zoning is, and will this be a factor in 2 to 3 years even potentially, right?
Well, just quickly on the cemetery as well, it's like seeing, okay, where is the cemetery and is it viewable? Is it actually in the resident's face? Because that's another side thing you got to watch out for, right? Oh, I'm looking at the cemetery. I don't want that unit right there, right? So,
Yeah. Good
so
news is I think this was like a 200-year-old cemetery. It was like very overgrown.
It's so real. I mean, in the residential side, we would see that all the time, that a house right across from the cemetery would get less. And the reality is with these larger communities, there's a few things that say a residential, if it's on a busy street, a straight residential single family home, generally that lowers the value. But with an asset that's on a busy street, because they're set back, the apartments, they don't get that same downside in rents. It's actually a positive thing because you get more exposure of drive-by traffic if you're on a busy street because how they're set back. So it's really interesting when you're evaluating properties. But you got to think, number one is when we're evaluating these, it's like if I'm a resident, what am I thinking when I'm going in to view the asset? And so we're getting into another topic, but I just with the cemetery part there, I think that's like it's really good because I mean we're looking at number of new starts that are coming into an area, but there's a lot of different factors. The biggest thing we look at is new housing starts in an area because it can really knock off your projected rents in a big way, and it can come pretty quick if you're not watching it.
I just have to mention it on the residential side, Mark, and I know you probably know this, but it is sort of ironic because back actually in the 1910s and 1920s and 30s, the people with money wanted to show off their house, right? So they built them on the busy roads. So if you go to, say, in-town Atlanta, like Druid Hills, Virginia Highland, Morningside, some of the premier in-town neighborhoods, like the biggest like houses are on those busy roads. But that impact occurs still because the just psychology has changed. People don't like it, right?
I didn't even know. I didn't know that. I didn't even think about that. I'm like, oh yeah, that maybe makes sense. As soon, if you're building the big house there back in the day. Now, out of all the thousands of homes that we've sold through the years, I just like
Well, I'll tell you what,
needs to be set back pretty far, and maybe in that case it's not an issue.
well,
But
just for fun, when we're in Noonan next time, I'll show you because Noonan was a town that was developed at the turn of the last century, right? The downtown area was built in the early 1900s, and there are these big, gorgeous homes like a block away from the restaurant or whatever. But it's just because they wanted to kind of show off, and then all of a sudden people realize, well, now there's all these cars and it's getting covered in soot, and then so they wanted to move.
because back in the day they wouldn't have all the traffic right in the noise.
That's right.
No.
But no, it's to your point, all these are factors, right? And you're dead on with an apartment building being on that busier road is actually a positive because of, once again, the exposure we get is actually free marketing, right? So what we found with our assets that are maybe on a quieter residential street that still have great access and all that, we generally have to turn the budget up a little bit on the online marketing just to make sure we get those eyeballs, where if it's right off a major road, we get a lot of organic walk-in traffic. So it's this is a very nuanced business. We'll just leave it there. So the next one, of course, is affordability metrics, right? And so what we mean by that is what we're going to be offering affordable in that area. So when we're talking about that, we look at median rent to income ratio. We also look at the average income in that area because those are two different things, of course. So what is that ratio? And so for us, basically, just so a person listening to this understands, to qualify to rent one of our units, you have to have at least 3 times the income of the annual rent. So that's 33%. But when we underwrite a deal, we look for 30% or less. So after we renovate these units, we want that rent to be, that annual rent to be less than 30% than the average and median income in the area. Now that's ideal. Sometimes we do 31, 32 if there's other factors at play, like a lack of supply or something like that. But at the end of the day, we don't want to go in and renovate the building in such a way that people just can't afford it, because we have to make sure we're meeting people where they're at. And so, is there room to raise rents in the future without pricing people out? Are people renting by choice or necessity is another question we look at. So you can actually see that in the data. Like, for example, if the average income in the area is $140,000, yet 40% of the population rents, that's telling you this is a choice. And we are seeing younger generations make that choice, whether it's a, factor of freedom and flexibility and not wanting to feel like nailed down to something. The average first-time home buyer in the United States used to be 28 years old. In the past few years, it's now 38. So you see that choice is happening more and more. And often in the markets we buy, like Charleston, Metro Atlanta, and Tampa, Florida, we are seeing that choice. We do like that, but necessity is also good, right? Because if we know that, that means absolute strong demand that will remain there forever. So it's a lot of different data points we have to look at. But when rents are affordable and they have solid upside potential, that's a great opportunity.
Yeah, a couple quick things on that. In just north of Toronto, say a city of called Barrie, it's about 160,000 population. The income to rent ratio is 50%. Toronto is 60%, and New York is 70%. And so this is why when we're buying these large multifamily assets, we like to buy in areas that are under, as John, you had mentioned, under 35% and
Yeah.
ideally under 30%. And so that means that there's going to be more potential upside. There's more people that can afford to take our units. And that's a big deal because we're buying properties, B class assets. These are like hometown heroes. These are like police officers. These are firefighters. These are like, beautiful people that are working really hard, generally more blue collar jobs. And we want to be able to go in and renovate and make a really nice, stone countertops, nice hardware, really nice upgraded, flooring, kitchens all done. And they can come home and they have a really nice unit, but they're spending, 1,600 to like 21, 2,200 a month and not spending 25 to 3,000 a month. And so we want to make sure that once we do the renovation, it's still affordable. And that's one of the things that gets me lit up here, John, is like providing, we'll say, first class service to the hometown heroes. And
Yes.
so this is like, I love it because it's almost like it's a pocket in a segment in the market that is generally, from what I've identified, is not served very well. It's like well, you're not A-class, you're not paying this. That means I'm going to be giving this subpar service. But a lot of the stuff that we do, John, is just a genuine love of people,
That's
and,
right.
and it's like this respect that we're giving, and it's like just great customer service. For example, the 48-hour maintenance requests are being done, and if not, we're going to give a concession if we don't get it done within that 48 hours. That's just one example. So we want to make sure that we're serving them, and if we're buying in a market that when we do the renovation and we increase rents, if it's unaffordable, then we're not delivering on that mission, and we're not able to allow more people to be able to come in to our assets. So the affordability is massive on that. Does that resonate with you, John? I know that was something we talk about quite a
A
bit.
100%. There's a lot of different type of operators out there with a lot of different business plans. And, frankly, a lot of the deals we've acquired, a lot of the upside's been achieved just because we treated our residents with a level of respect that they're not used to. In other words, the prior operator, I mean, we're now, closing on our fifth asset. And this is the second that we've closed on where there are like plants growing out of the gutters, right? Like, and at the end of the day, that's just a miss on the maintenance of the building. That kind of stuff leads to water intrusion and further issues. But it's just imagine you're paying, 1,800 in rent and you come home and that's the first thing you see when you pull up into your unit, right? It's almost like a contempt, I feel, that some of these operators, not, and I want to be very clear, not all, most are actually very good. But it's just that idea that they're just buying it as an investment and they're not really paying attention to those details. And what we found is that, when we treat people with respect, we provide a high level of service. We're always available. Our property managers are lovely, awesome people that have that genuine love of people baked into their very character. It's not something you can teach. They already have it. We've had situations where we're actually achieving rent on a classic unit that we thought would be the rent we would get on a renovated just because the service is there and they're like, we just love this community. We want to stay here. And so, customer service in and of itself is disruptive in a lot of industries, and this is one that I think is a very good example of that. So, yeah, it's I couldn't agree more with everything you said there, Mark.
The other thing with affordability is the just to give some context, you can buy a $400,000 condo in say Toronto, one bedroom condo, very small, like 500 square feet. That is very low actually for say Toronto. In Tampa, you can buy a 400,000 two-story, fully detached home, 1,800 square foot home. Like the the difference, that's affordable. That has you can get way more for your dollar, and so you can live in say Charleston and make half the amount, half the income, and have the same lifestyle as somebody that's living in San Francisco making twice as much.
That's right.
And so this is what when we're talking affordability is just it takes less to live, and that's what attracts people to come in, especially today as pricing's going up. There's inflation out there, everything's getting more expensive, and incomes are not matching up, and they're not pacing what inflation is right now. So overall, there's more and more people that are not able to actually get out and purchase. And so this renter, we are becoming more of a renter nation.
Yeah.
And so that's just a real thing, and it's getting tougher and tougher out there. And so we want to be able to serve that segment of the market.
Absolutely. And it does actually bring to mind another fact we look at is the average and median home value in the area, because we have identified some deals. And as we're digging in deeper, what we realize is that, the mortgage payment on the average home isn't that far away from our renovated rents. So that's a market or an area we'll actually pull away from. Because at the end of the day, we're renting units here. So if somebody can go buy something, right? Now, once again, some are renting by choice, but it just, I wanted to share that just to illustrate the point. It's very deep research you have to do into these markets. So if you're like thinking about buying a rental property, this is a level of due diligence you need to do on the area you're thinking about acquiring that building in. Now, this is one we talked a lot about too, Mark, point number 5, but landlord friendliness, right? So, it's interesting. Sometimes you hear landlord friendly and you assume, oh, does that mean that they're unfriendly towards the tenant? Actually, if you look at the research, things like rent control and, regulations that make it more difficult to evict non-paying tenants actually have a very long-term negative impact on that area. In other words, you're disincentivizing apartment owners and developers to develop or to own properties in that area, right? If you can only raise rents by 2.5%, for example, like you can in Toronto on an annual basis, and there's some major capex that has to occur at that property just from like, say maybe you need a new roof or something like that. But by doing that, you basically destroy the economics of this investment, and that's what leads to what I would say are like the slumlord kind of effect, right? Where it's like, if I can't raise the rent, so I'm just going to let the property fall into disrepair. And so the markets like, California, New Jersey, New York that have those rent controls often see less new development. So when we say landlord friendliness, it's not implying resident unfriendliness, right? It's just more, how long does it take to evict a non-paying tenant? Candidly, we were actually at a property recently doing a tour, and one of the residents was allowing their pet to use the restroom inside the unit. They literally had fenced off the living room. And I'm not lying when I say I couldn't even go inside the unit. The smell was so horrific. And so there are markets where it would take 18 months to get that person out, even though they are creating a biohazard for the rest of the community. And so, leasing violations, somebody's smoking cigarettes, somebody's bullying, their neighbor or playing music to all hours of the night. And I got to go through 18 months to get them out. That's really affecting all these residents, not just me as the owner or us as the owner, the operator, our investors. It's having a negative impact on the whole community. So that is something we look for. We are very thoughtful. And so if somebody has a temporary blip, maybe the husband lost the job, but they got another one lined up and it's a dual income family, we'll work on a payment plan. We're not about throwing people out on the street. But if someone's just not paying their rent and they're trashing the unit, then we can get them out fast. That's a benefit to the rest of the residents and a benefit to us as owners and our investors. And so it's important that we have that in any market we invest in. And, once again, there's reasonable rent increases, right? It's not about just jacking up the rent to jack it up, but, we need to get market rent at the end of the day. So those restrictions, those regulations are something that we look for. And if a market is heavily regulated in that way, it's not a market we're willing to invest in.
You nailed it, John. You said everything that was perfect. And then the final principle here, number six, is the what is happening directly in around the area. So quality of life and amenities. So why we like going on Google Maps when we see an asset and then making sure definitely we're driving the asset as well is that when you drive out of the community, you want to make sure to see what are the commercial buildings that are close by, and are they like pawn shops, are they, alcohol and smoke shops close by? Because generally that's in a, we'll just say, not in a safer area. We want to make sure that our residents feel safe. And so safety and crime is another thing that we look at as well. And we want to be able to know that our residents can leave, they can go to a really good grocery store, they can go to, ideally if there's Walmart close by, that's really good news. Costco, I mean, these are good. These large, we'll say, stores like
Yeah, the big
Walmart
box.
and
Yeah, that's
Costco,
right.
big
Yeah.
box, or like Starbucks. Like these guys do their research ahead of time, and they know that the clientele is there. So that's a good sign when we start seeing those larger businesses that are there. But we want to make sure that our residents are safe. There's amenities close by that they can live, and that they're not going to have a reason to want to leave and go into another community just because they have all the amenities around the asset that we can't change. We can buy an asset, we can make it better, but the amenities and what's in around the area and the safety side of it, we don't have an impact on.
That's right. Yeah, the crime is huge, right? So there's websites we review, Spot Crime being an example. We go on the county website. A lot of the sheriff's departments and local police departments publish their crime stats. You can kind of get a sense of what's happening. But what's cool about Spot Crime is we can actually drop the address on it. We can see all the arrests that have happened in the past year in that surrounding area. And that's why we have to go on the government sites to get like the further back data. But every area has some level of crime, right? So if we see, say, for example, a DUI or, maybe, and I'm not making light of this, but like domestic assault. I mean, these are just things that happen in all areas. Beverly Hills, right? I mean, they have, the most expensive, market you can find in the world. Those kind of things happen. Petty theft, things like that. That stuff happens. Kids steal gun from the gas station, right? But if we see shooting, drug dealing, that kind of stuff, we walk away immediately. But yeah, that those amenities, as you mentioned, you said it right. Chick-fil-A, Starbucks, these companies do so much research into these areas before they go. So we kind of sometimes joke about the Chick-fil-A index. If there's like a Chick-fil-A within like a mile of our property, like, all right, good news.
Well,
Because they
because John, that's a requirement when we look at the assets. We have to go to Chick-fil-A, so that's the biggest reason. It's not even for the residents; it's for us going to look at the asset,
Yeah,
right?
that's right. That's right. We're always on the move, and we're eating as we go. Shoot, we've had some property tours, Mark, where we didn't even get food in all day,
Yeah,
because we
no,
were go.
no, that's
Um,
my one joke for the day. But the reality, yeah, I mean, we've gone many times, and it's
yeah,
just like we've been going asset to asset. All of a sudden, oh, we didn't eat lunch, and George is upset now at us because we didn't grab lunch now. So
yeah,
I learned my
and
lesson though the one time.
yeah, that's right. That's right. When you saw me come with like a backpack full of protein bars, you're like, all right, we'll make sure we stop for lunch this time,
Yeah,
John.
yeah.
All that to say, too, for example, we're looking at a deal now. It's actually our newest deal. We'll be launching soon, but it's a mile walk to the downtown area where there's just like really great little cool restaurants and shops and all that. There is like 10 miles of walking and jogging and biking trails within walking distance. There's a community park nearby, about one exit up the highway, so about a 2 to 3 minute drive. All the big box retailers, so the Costco's, the Walmarts, the Targets, the Dick's Sporting Goods, the Bass Pro Shops, all those things. And so all those conveniences are right there. And we're also looking at schools, of course, right? Like school scores. Is this an area that has average or above for the state? Is what we look for. So all those things matter, because at the end of the day, if residents don't want to live there, then we're going to have a problem. So we need to make sure it's not only just the asset, but it's that surrounding area and all those amenities that it provides there. So those are the six reasons. Now, how to vet a submarket within a city? Might look good, but the neighborhoods will vary. So go deep, drive around, get broker input, do demographic overlays. We talk about those paths of progress. So there are some examples for Where I live in Atlanta, for example, where, there's no mountain or body of water to slow our growth. So, the city keeps expanding outwards, but you can see these passive progress. So like the Northeastern corridor is one of the stronger ones in Metro Atlanta. So city I live in, Alpharetta, but out to Gwinnett County, those areas just continue to see great population growth. They're well-managed counties, well-managed cities within those counties. So a lot of new amenities being built from the local community, so parks, amphitheaters where they host weekend concerts and farmers markets and food truck Friday and all those kind of things. And it's like, that's a vibrant community. So those are the areas you want to be in. So those passive progress are super important to kind of dial into. And often you really can't do that until you get on the ground and drive around and see it for yourself. Because you nailed it, right? If it's a bunch of pawn shops, tattoo parlors, and, tidal ponds, it's like, an area that's probably on the down cycle, right? If you're seeing yoga and Pilates studios, that might be signaling something a little bit different, right? So it's just that idea, you use all the online resources, all the data you can find, but there's nothing that can substitute just getting on the ground and driving around and getting to know the area.
You got it, John. And so to kind of wrap everything up, so the markets we really like, so Charleston, South Carolina, we like Tampa and Jacksonville in Florida, and we like Atlanta in Georgia. These are markets that do check the boxes. John, you had mentioned there, the submarkets become really important. And so that's where that's our honey hole, so to speak, and those markets there that I just mentioned. But if you do these 6 principles when you are assessing a market and you get the right data, then you can make an educated decision. And once you get the data, it's really important to compare to other cities and then make your selection and then go all in, go deep, and make sure that you continue to, we'll say, survey and research the information, because things can change with an announcement here or there. And you want to make sure that whenever you're going into a market or continuing to invest in a market, that it's always the right market to invest into moving forward.
That's right. You mentioned it earlier, Mark, but to learn more, go to fulloutinvesting.com. It is a great resource. You can learn more about our 10-step full out process to selecting investments and ensuring our investors double their equity in 5 years. We have a sample deal deck on there. You could also book in a time to talk with Mark, just to talk strategy, talk investments, talk whatever. We're always available.
Well, thanks for listening, guys. If you enjoyed the show, please subscribe and share the channel with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.